Our first project in Accounting 245 deals with how we allocate the net income and net loss in a partnership amongst the various partners. Partners can decide to allocate net income and net loss in any manner that they come up with. Okay, it is up to them to decide how they're going to do that. They may have one method for allocating net income and a different system for allocating each net loss. Each partner has a right to share in the profits of the business, but they also each have an obligation to share in any losses that the partnership should incur. Whatever method the partners choose, they need to document how they will allocate their net income and net loss in their partnership agreement, so there's no question about it later on. What we're talking about here is the third closing entry. You'll recall from your first accounting classes that the first closing entry closes out revenues, the second closing entry closes out expenses, the third closing entry closes out income summary, and it closes it to the partner's capital. If the partnership has a net income, we see the third closing entry looks like this. We debit income summary to get its balance down to zero. We credit the owner's capital to make it go up. Crediting capital makes capital go up. Well, if we earn a net income, that makes the net worth of our business also go up. If we have a net loss, we find we have to make just the opposite entry. We have to credit income summary to get its balance down to zero, and then we have to debit the owner's capital. Debiting the owner's capital makes it go down. Well, if we had a net loss, the net loss also makes the net worth of my business go down. Now, with a sole proprietorship, the amount of the third entry, what it took to close out income summary, went automatically to the owner's capital. But what we're concerned about now is if we have a partnership, that means we have two or more owners. So how will we divide the net income or the net loss amongst the partners to know how much to credit each partner's capital account for or to debit it for? And that's what we're going to do in this project, is to come up with a worksheet that would allow us to do this. Generally, in most partnerships, net income is allocated based upon three variables: a salary allowance, an interest allowance, and a ratio. The salary allowance is a way of simply acknowledging how much time each partner spends in the business. If you have one partner who's working 40 hours a week in the business and another partner who's working 10 hours a week in the business, it only seems fair that we should give the first partner more of the partnership net income as a way of acknowledging the extra time he's spending in the business. Now, this is not salary expense. This is not a paycheck that we are writing to the partners, but instead it's a way of simply acknowledging that the partner who works in the business more should get more than net income. This is not drawing. This is not drawing, the owner taking money out of the business for personal use at all. Why give a salary allowance? To acknowledge how much time a partner may spend working in the business. The second thing we would consider would be having an interest allowance. An interest allowance is a way of acknowledging how much money each partner has invested in the business. This is not interest expense. This is not something that we will be paying to each individual partner. But instead, when it comes time to allocate the net income, we need to take into consideration how much each partner has invested. If one partner has $1 million invested in the partnership and the other partner has $10,000 invested in the partnership, it seems only fair that the one who has the larger investment should get a greater portion then of the net income. So we can give a salary allowance, we can give an interest allowance, and at that point there usually is some sort of a remainder. That remainder will be allocated between the partners. It may be a positive remainder, it may be a negative remainder, but regardless, we will allocate it according to whatever ratio the partners then have decided. Our first example includes the following data. We have a net income of $80,000. Larry is going to get a $22,000 salary allowance. Curly is going to get an $18,000 salary allowance. An interest allowance of 20% will be given on each partner's beginning capital. Larry's beginning capital is $10,000. Curly's is $20,000. Whatever remainder there is after the salary allowance and after the interest allowance will be distributed 40% to Larry and 60% to Curly. And we're going to fill in the following table then as we decide how much to allocate to each partner. First off, we're just going to fill in the salary allowance for each person. Larry's salary allowance was $22,000. Curly's was $18,000, which means now we have allocated a total of $40,000 in salary allowances. The interest allowance is going to be each partner's beginning capital times the rate. So for Larry, his beginning capital was $10,000. A 20% interest allowance says he'll get a $2,000 interest allowance. For Curly, his beginning capital was $20,000. 20% of that says he's going to get a $4,000 interest allowance. And now 2 plus 4 says we've allocated $6,000 in interest allowance. Next, we'll figure our subtotals. For Larry, the 22 plus 2, he's getting a total of 24. Curly's getting 18 plus 4, or 22. And at this point, we have now allocated $46,000 between my salary allowance and my interest allowance. In total, we had net income then of $80,000. We have already allocated now $46,000 of that amount, which means that we now have a remainder of $34,000 that we need to allocate. We're going to split that according to the ratio. Okay, so for Larry, we have $34,000. He's supposed to get 40% of that, or $13,600. Curly is supposed to get 60% of that, or $20,400. And finally, we'll figure the total for each partner. Larry, we're just going to add up his 2 figures. Same thing for Curly. And now we have allocated $80,000. Notice that that total equals the amount of our net income, which is what we were trying to do. We were trying to decide how much of that 80 goes to Larry and how much of it goes to Curly. So we've decided that $37,600 goes to Larry, $42,400 goes to Curly. Now that we know the numbers that go to each partner, let's review the actual closing entry itself. As a review, our first closing entry closes out revenues. Now, revenue accounts have a credit balance to begin with, so to close them out, we're going to have to debit those accounts, and the credit goes to that new account we use just to facilitate the closing process called income summary. The second closing entry closes out our expense accounts. Expenses have a debit balance to begin with, so if we're trying to get their balance down to 0, we're going to have to credit those accounts, and the debit then goes to income summary. So if you think about the income summary account now, we've done 2 things to that account. We have credited that account for the amount of our revenues, and we have debited that account for the amount of our expenses. The difference between the revenues and expenses is my net income. So the balance in income summary right now represents the amount of my net income. If we have a credit balance in that account, that means we had more revenues than expenses, so we had net income. If we have a debit balance in that account, that means we had more expenses than we did revenues, so we have a net loss. Our third closing entry simply needs to get the income summary account balance then down to 0. If the income summary account has a credit balance at this point, that means we had net income. To close it out, we're going to debit income summary to get it down to 0, and my credit goes to the owner's capital. If we had a debit balance in income summary, that means that we had a net loss. To get income summary down to 0, we're going to have to credit that account, and then the debit would go to my capital account. We want to think about the impact this has on capital and make sure this makes sense. Well, let's see. If we had a net income, we find ourselves crediting capital. Crediting capital makes it go up. Well, earning a net income makes the net worth of my business also go up. If we find ourselves in the closing entry having to debit capital, well, debiting capital makes it go down. If we had a net loss makes the net worth of our business go down. So that also makes sense then. One more example here. Let's suppose that in income summary, for the first closing entry, we closed out revenues of $100, so we credited income summary for $100. In the second closing entry, we closed out expenses of $70, so we debited income summary for $70. At this point, we have a $30 credit balance in income summary. That represents the net income because the amount of my revenues was greater than the amount of my expenses. To get income summary down to a 0 balance, then we're going to have to debit income summary to get its balance down to 0, and the other part of that entry then would be a credit to the owner's capital. We need to think and make sure that this makes sense. Well, let's see. We had a net income. Earning a net income makes the net worth of my business go up. Crediting capital makes my capital account also go up. Let's do one more example here. Let's suppose that my income summary account has a credit entry of $100 where we closed out revenues. It has the debit entry of $170 where we closed out expenses, leaving me at this moment a $70 debit balance in income summary. That balance is a net loss because the amount of my expenses exceeded the amount of my revenues. So in my closing entry, I need to get the income summary account down to 0. Income summary has a debit balance, so to get it down to 0, I'm going to have to credit income summary to make that entry balance. In this case, then my debit goes to the capital account. Debiting capital, well, that makes the capital account go down. That makes sense because we had a net loss. Having a net loss makes the net worth of my business also then go down. So that's how it looks for a sole proprietor. If we're trying to do this for a partnership, the only difference is we've got to decide how much is each partner's capital affected in this closing entry. So instead of having just one debit or one credit to capital, we're going to have a separate one for each partner who's getting a portion of that net income or net loss then. Let's now return to our example we were working on just a minute ago. In our table, we decided how much of our net income should be allocated to Larry and how much should be allocated to Curly. When we go to make the journal entry now, we're going to debit income summary for the $80,000 amount of my net income, and this time we will credit each partner's capital for their share of the net income. We decided Larry was getting $37,600. We're going to credit his account for that amount. We decided Curly would get $42,400. We'll credit his capital account for that amount. Crediting their capital makes it go up. That's because we had a net income, which makes the net worth of my business also go up. Let's do a second example. Only one thing will change in my second example. Instead of having a net income of $80,000, we now will have a net income of $10,000. Everything else remains the same. The first 3 lines on my chart will not be changed. They're exactly the same. What will change, though, is my remainder. I have a net income of $10,000 to allocate. I've already allocated $46,000, which says my remainder to allocate then will be a negative $36,000. Negative remainder. We're going to mathematically handle it just the same as in our previous example. My remainder is a negative $36,000. We're going to give 40% of that to Larry, so he gets a negative $14,400. We're going to have 60% of that for Curly, so he's going to get a negative $21,600. When we add the subtotal plus the remainder, we decide that Larry is going to get a total of $9,600, Curly gets $400, and together we've accounted for $10,000 in net income, which is what we were trying to do. When we go to make our journal entry for example 2, we're going to debit income summary, this time for the $10,000 net income. We're going to credit Larry's capital for his share, what we decided he should receive, and then we're going to credit Curly's capital for the $400 we decided he should receive. Again, both partners' capital accounts are credited, which makes them go up. We had a net income, that makes the net worth of our business also go up. Let's do one third example. And in this third example, we are again going to change just one thing, and we're going to change the remainder. We're leaving net income at $10,000, but now my remainder has changed to where it's going to be distributed 10% to Larry and 90% to Curly. Again, we go back to our table, and the first 3 lines are unchanged, just as we had them previously. My remainder will be just like it was in example 2. $10,000 net income minus the $46,000 that I have already allocated says that my remainder is a negative $36,000. Now I need to take that negative $36,000 and allocate it between my 2 partners. We decided that Larry was going to get 10% of that, so he gets a negative $3,600, which is 10% of the $36,000. Curly's going to get 90% of that. 90% of the $36,000 says he gets a negative $32,400. When we figure our totals now, we see that Larry gets $20,400, which is the $24,000 minus the $3,600. Curly, though, says he gets a negative $10,400. So his capital account is not going to go up, it's going to go down instead. Again, we have accounted for $10,000 in net income. To make my journal entry, I'm still going to debit income summary for $10,000. Larry's capital needs to increase by $20,400, so we will credit Larry's capital for $20,400. Curly's capital, however, needs to decrease, so we will debit Curly's capital for $10,400, which makes it go down. Notice that we do not have a negative number in the journal entry. Instead of having a negative credit instead would become a positive debit. So we are debiting Curly's capital, which makes it go down. We're crediting Larry's capital, which makes it go up.